if it's done right, the standard deduction plus these additional deductions, how it can potentially significantly help their overall tax and income planning in retirement. Welcome to How to Retire on Time, a show that answers your retirement questions. My name is Mike Decker. I'm a licensed financial advisor and fiduciary, and joining me here and my co-host, Mr. David Franson. David, thanks for being here.
Yep, happy to be here.
As always, we're going to answer your questions. Text them to 913-363-1234. And remember, this is just a show, not financial advice. So make sure to do your research and follow up with whatever we talk about. David, let's dive in.
Hey, Mike, I heard that Social Security is now tax-free. Is that true?
That is not true.
Oh,
I know that many politicians are saying that, including President Trump has said we got Social Security to be tax-free. It's not an accurate statement. So just for context, as of the time of this recording, around 64% of people receiving Social Security were receiving it tax-free. And that's under these Social Security tax brackets that if you make less amount of money or a certain amount of money, that 0% of your Social Security be subject to tax, okay? And then there's 50% of your Social Security be subject to tax, and then 85% of it. So it's important to understand that 64% or so of people receiving benefits just were living off of very little. So they were being taxed, or basically 0% of their Social Security is being taxed. Okay, you with me so far?
yeah. So we're talking federal income taxes. Well over half currently just don't even pay taxes on those benefits.
Yep.
Okay.
The changes that have been implemented by the One Big Beautiful Bill are expected to increase that amount to about 88% of those who receive their benefit to not have to pay taxes.
Uh-huh.
Now, the question that's the most important question is how does that happen? And what I've found is many people, they know that they file their taxes. They know roughly that there are things like the standard deduction and there's tax deductions that you might itemize. There's tax credits, and a credit's dollar for dollar off, deductions not dollar for dollar. There's all these things that go into a tax return. But if you had to ask someone, well, what's the order of the tax return and how is it calculated? I found most people don't actually know that process, which is fine.
Yeah.
I don't know the process for a surgery. I couldn't go to court and tell you due process of what a court proceeding is. I mean, I don't know these things, right? So it's normal for someone to say, I don't know the sequence of the tax return filing preparation because that's not my specialty. And TurboTax is a great way to file your taxes,
Right.
but the calculations are happening in the background. You're not going, okay, well, this right here and then this right here. No, they made it really easy for people so you don't have to think about it. Well, right now you do need to think about it, and here's why. I've gotten so many calls from people saying, how does my file strategy change because of the new One Big Beautiful Bill changes for Social Security? I hear that it's now tax-free, and should I change? It's the wrong question. And the reason is they didn't change Social Security taxation. What they did was they have adjusted the standard deduction so that if you are 55 years or older and your modified adjusted gross income is less than a certain threshold, so for married couples, if it's less than 150,000, then you get an additional 6 to 12,000, so 12,000 for a couple.
Mm-hmm.
You get an additional amount of your adjusted gross income to be deducted from your return. So
Okay.
whether you're taking Social Security or not, it's irrelevant. It's does your modified adjusted gross income, is that low enough that you qualify for an additional deduction on your benefits or on not your benefits, but your taxes overall.
Okay.
So let me walk you through really quickly the correct order in doing tax preparation. Okay. First off, you have to figure out how much of your Social Security is taxed. How does that happen? It's called the provisional income. And the calculation, for the most part, is as follows. Take your total Social Security benefit, if you're taking it, divide that in half. Now, add in all of your taxable income. So pensions, if you've got an annuity that's from a pre-tax account, like an IRA annuity, that could be taxed. You've got your W-2, W-1099 income, any taxable income stream, right? You're going to add all of that in there. And then any of your tax deferred or exempt income. So specifically think of your municipal bond interest, okay? All of that gets calculated dollar for dollar plus half your Social Security, and that helps you figure out, okay, Am I paying 0% of my Social Security benefits taxes, 50% in taxes, or 85% subject to income tax? Are you with me so
Okay.
far?
Yeah. So if I made $5,000 a month in Social Security benefits, potentially I'm paying 85% of that 5,000 a month is getting taxed potentially.
Maybe, not
Hmm.
necessarily, depends.
Okay.
So for a couple, 32,000, 0 to 32,000 is the threshold. So 5,000 a month in Social Security benefits, let's say as a household, that's what 60,000 a year.
Mm.
60,000 divided by 2 would be 30,000. You would be in the zero tax bracket
Oh.
or 0% of Social Security being taxed if you had no other income.
Oh. Right. Right. Right.
Or maybe it all came from your Roth as an example. But if you took $2,000 or more, your Social Security taxation is immediately bumped from 0 to 50 or 85% is subject to tax.
I
This
see.
isn't a progressive situation like the income taxes. This is all or none, and you got to figure out where you stand.
Mm-hmm.
So things like dividends, whether you're using them or not, if they're being reinvested in your brokerage account, can disrupt this calculation. Leaning into municipal bonds can disrupt the provisional income tax calculation. These are important things to understand because, oh, well, that's tax free, kind of, but it could affect other parts of your plan. Okay, so that's the first part. So you got to figure out, okay, is your Social Security subject to, is it 0, 50, or 85% subject to taxes? That's the first part. Then you've got to go over and figure out, okay, what is your adjusted gross income? So that calculation now is the taxable part of your Social Security.
Okay.
Okay, so whether it's like if you have 60,000 in Social Security, but you've got a little income elsewhere, so maybe it's 50% of your Social Security is going to be taxed as income, or 85% of it's taxed as income. All of your taxable income is a part of your adjusted gross income, but your municipal bond interest, for example, is not a part of this taxation because it's your adjusted gross income. So we're trying to figure out then what is your adjusted gross income provision, because you need to do that then to figure out what your capital gains bracket is. So if you're taking income for your long term, you see how
Mm.
this gets complicated?
Lots of moving parts I'm seeing here.
Okay, so I'll gloss over the next little bit here, but you figure out then is your are your long term capital gains subject to a 0%, 15%, or 20% in capital gains if it's long term. Okay.
Okay.
And so if that happens, then you figure out that calculation, and then you move on to then the next part of the calculation, which would and I'm simplifying it, so the CPAs are probably rolling over, going, "Oh my gosh, look, this is a podcast, this is a radio show. We're keeping it simple.
Hmm.
There's a lot of nuance when filing your taxes. I'm keeping it simple, but you got to figure out your modified adjusted gross income next. And the reason is, the question is, in this situation, is your standard deduction going to apply and that's it? Or are you going to have the standard deduction plus this new one big beautiful bill deduction as well, which will sunset in 2031?
Mm.
Okay. And so if that happens, then you get your taxes, and then it's like, okay, here's based on your modified adjusted gross income, here's your calculation. Now you get the standard deduction, and maybe you qualify for this new additional deduction for seniors. So maybe you have an additional 12,000 that's getting deducted from your total taxable amount, and all of that then calculates to then the income tax brackets and so on. So the question is, oh, well, Social Security is now tax free. No, it's not. They've changed the standard deduction to try and help more people not pay taxes or offset the taxes they would have paid in their Social Security.
Mm.
But it's not an apples to apples situation, because you could utilize this to just do more IRA to Roth conversions if you're within the modified adjusted gross income threshold for your situation. You could use it to, manipulate other parts of your plan. It's not actually tied to Social Security. The truth is that they increase the standard deduction to offset some people's Social Security taxes to try and alleviate them, while other people who are making more money are receiving no relief, and it's just kind of the same as it always was because you won't qualify for it. So for those are enjoying 200, 300,000 in retirement, according to your modified adjusted gross income, this is irrelevant. It doesn't make a change.
Because they'll still be paying the same old that they've always
Yeah,
paid, right?
they don't qualify for this deduction. It really was, the wealthy are not receiving these benefits. Those who are enjoying less in retirement are enjoying these benefits,
Mm.
and they should be utilized. I fear that those who have 700,000 or less don't understand the magnitude of the next few years, the next 5 years, and how if it's done right, the standard deduction plus these additional deductions, how it can potentially significantly help their overall tax and income planning in retirement.
Mm. So it sounds like good news then for a large chunk of people.
Yeah, for people that have less than $1 million in their IRA accounts,
Mm.
this is a huge opportunity and it depends on how much you have in your pension, what your Social Security. There's a lot of factors in here, but it's a huge opportunity to just move more money where it needs to go in preparation for things like required minimum distributions and legacy planning and so on. And the list goes on and on and on.
And so how would the average people out there, how would they even know about all these nuances and all this?
It's so complicated. I mean, it allows us to become nostalgic for the good old days of the pension.
Oh, yeah.
When you worked for 30 years, you got a pension and you lived off it and all was well. There's a reason why I think we as a people really enjoyed the pension. Now, I know there are some people that enjoy the 401k and they like that, the additional flexibility. But when you get down to the core of an individual, I would say most Americans would have rather enjoyed a pension than the additional responsibility of having to figure out how do you take this 401k and navigate the tax nuance, the income nuance, the market nuance, even the healthcare nuances, now how it affects all these different factors and the longevity risk. And I mean, there are 60 risks that you may not know exist.
Mm.
So, but this is how it is, and we move forward.
Yeah.
So I want to point out something that's really important, though, in this conversation. As humans, we like simplicity, especially when it comes to retirement planning. But if you'll notice, there's been a significant change, not just in the tax planning side of it, but a number of other parts of now how our financial system works. Okay, if you're living off a pension, or if you bought an annuity and turned on that lifetime income stream, there's really nothing you can do to adjust your retirement to take advantage of these opportunities. You are in a reactive position. Now, for all those who built a plan that offered them growth and flexibility with sufficient protection, because when I say sufficient protection, I mean that they have enough protected for the down markets. When the markets crash, they can sail through it. For those that have that flexibility, they're the ones that are rewarded for these changes, because the tax code is written in pencil. It changes from time to time. And unless you can dynamically change your plan, your income plan, your tax plan, your healthcare plan, all of the above, you just might miss these huge opportunities. And that's one of the biggest takeaways, I think, from this question. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.